Good morning. Welcome to Forex in Four. Today is Wednesday, October 19th, 2011. Alrighty, this morning again we're going to start off with our discussion of the euro because that's what we do every day. We know about what's going on over in the eurozone, but let's just take a quick recap of what's happened here over the last couple of days. So yesterday we had euro selling off a little bit as U.S. session opened in the overnight. All right, a lot of risk aversion in the markets. We got down to just above this 136.50 area where we sort of settled in. All right, and we started pushing back up just a little bit higher. It looked like it was maybe going to be a little bit of a market retrace there, and then news popped out from the Guardian, and which is a newspaper it's sort of known for its I don't want to call it tabloidism, but there's a lot of they break stuff early, that kind of thing. I'm not going to say that they're not a respected newspaper, because they are, but it's just one of it's a little bit more, I don't know, tabloidy, if you will. I don't know if that's describing it properly, but in any event, they reported that Germany and France were near an agreement to increase the size of EFSF to 2 trillion, which is about 4 times what they had on the table before that. They're talking about leveraging it the whole bit. So boom, you can see all of a sudden market took off, started moving higher. Well, we got a little bit of a pullback, all right, and then it kept going up, until a little bit later we got a pullback just a little bit on Apple earnings from last night. All right, that took S&P futures a little bit lower. Apple reported their first miss in, I don't know, 4 years, but we all know Apple's a great company. All right, iPhone, iPad, you name it, they sell it. Everybody wants it. So Apple stock was off in the after-hour session. That pulled futures down. Correlation happened with Euro, pulled it down as well. But once everybody sort of shook that off, boom, Euro's moving higher on this renewed hope that indeed that Euro leaders are coming to some sort of agreement, and the market's really blown off some other news that's happened. Moody's downgraded Spain, and everyone was like, yeah, so what, who cares? If they increase this EFSF deal and they figure out this debt crisis, then it's going to be game on again. So you can see here, Euro moving higher. We're just looking at the 30-minute chart, and just a nice steady decline. I had that nice little pullback there, but a steady ascent rather, not a decline. Thank you. And we're just sitting shy of 138.50. Just want to show you pound dollar. Okay, the minutes from the meeting came out, and you can see here we had just a little bit of a sell-off there. They voted unanimously. All nine members of the BOE voted to expand the asset purchase to 275 billion. All right, and they're saying that the inflation that they're seeing yesterday, which is very high, over 5% yesterday, was just a temporary spike. So we're gonna have to monitor that situation going forward. But this may be the situation where they might have to reverse policy rather quickly, especially if Eurozone gets their act together. But you can see here, and there's no real a better place to look at it is actually if we can look at euro pound, okay, and you'll see that euro pound moving higher on the Great Britain, UK Bank of England meeting minutes. So that's what's going on there overnight. Okay, those are all good things. Just show you Australia. Australia, they've had a leading indicators came in a little bit better than expected. Okay, and all these charts sort of look the same. You can see here, there's a spike, there's the pullback, and the move higher. We know Aussie is highly correlated to Euro. All right, we're sitting just under a little bit of resistance, 103.50. Now, U.S. stocks are set to open just about flat to higher. Okay, but we had that big push into the close yesterday, so we could potentially see a little bit of resistance up here, say 103.50 for Aussie. All right, say Euro 138.50. So those are areas of, seems like, natural resistance. Okay, we're getting a little bit of stochastic sell-off. I could see a situation where markets sort of pull back a little bit in hesitation of these moves because we're not quite exactly certain what's going on. Just want to show you gold here. We pulled out last week, and we said that we had a little bit of a bull flag going on. Well, we had this big spike down in gold yesterday, and I'm just going to pull it back to the daily chart. All right, and we have this bull flag, or excuse me, bear flag here that we called, that we're talking about a return to perhaps 1400 or 1350. I forget what the target was. But if we get a daily close beneath 1640, then we think that there could be a decent short coming there for a couple of $100 with the stop just up above 1700. So we'll have to wait and see what happens, and maybe that's going to be the debt commission this weekend in Europe. They're meeting, and Merkel's already trying to downplay it, saying, well, this is just a step in the right direction. This isn't the end-all be-all this weekend. But if they do get some positive news out of this debt commission, then we could see perhaps a little bit of gold selling. All right, because the safe haven properties that have been invoked, but I think that'll be short-lived because we're going to see inflation spike if the euro does better. And speaking of inflation, we're going to get the CPI data out in the U.S. this morning. All right, we're expecting the year-over-year number to be at 3.8%, with the ex-food and energy, the core number, at 2.1%. All right, we're also going to get building permits here in the U.S., and we're going to get housing starts as well. So that's going to let us know if we have any construction activity going on. All right, and then one other thing to take a look at is going to be Canada's leading indicators index. All right, they're expecting 0.1%, so that's really nothing going on there. But if those pick up, then it could also be a good sign for overall risk in the market. We can look at oil. We can see here oil prices. All right, they moved back up dramatically as of late, and you can see here we've got this daily rise going on where we are just under $90 a barrel here. And I think if we see some higher CPI data, we could see a spike up there. And now people are going to start to wonder, well, hey, what's the Fed going to do? Is there any problem with inflation? And it's apparent that these guys are not worried about inflation at all. In fact, they're trying to encourage it. All right, we've gotten to a point here in the U.S. where the banking system is such a mess that it's really going to be difficult for prices to go any lower, especially for big ticket items like houses. And the housing market is really the huge drag on the economy right now because nobody wants to face the reality that, you know, prices still may be overvalued. All right, and they're talking about, well, how low interest is. You can get into mortgages with low interest. People are afraid to do it, okay, if they think that the value of their home is going to fall. And if the value of their home falls, all right, they feel like they're not going to get any relief, or that you know, they're not going to be able, they're going to be stuck there, all right, and they're going to be, you know, sitting with massive losses. And the banks, of course, don't want to do it because now they're afraid people are just going to walk away. So the banks aren't lending money. So you've got this housing problem, and somebody needs to come up with a comprehensive housing problem that doesn't involve Fannie Mae and Freddie Mac, these, you know, political appointee guys who just pull out massive amounts of money for doing essentially nothing. All right, so basically the U.S. government guarantees all mortgages now anyway through Fannie and Freddie, which are essentially bankrupt companies. And somebody needs to come up with a plan here ASAP so we can get back to buying houses. I mean, listen, you know, we're at interest rates that are at all-time lows and historically super duper low. I mean, that's encouraged prices to stay high. If we can get, I think we need to see some sort of comprehensive plan on housing. I think we need to see a little bit higher interest rates. All right, that would strengthen the dollar. All right, that would make stuff overseas cheaper to us. All right, that would bring inflation down. It would also bring housing prices down, which people might be more apt to get into them and look to buy. All right, but what's that going to do? Well, that's going to hurt the banks. That's going to hurt current homeowners. Well, let's come up with a plan that helps them. All right, maybe it's government participation. Maybe it's some sort of legacy loan. I don't know what the answer is. Well, I've got some ideas, but I'll wait to put them out when I launch my platform for office. So anyway, that's kind of what we're looking at. So I'm just going to be nervous about the news that's popping out throughout the day. I mean, you know, you've got these strikes in Greece. You got papers like The Guardian leaking information, things like that. So we could be prone to a little bit of volatility happening. And then, of course, we've got U.S. stock earnings happening throughout the day and at the end of the day. So we'll see what those have to say as well. But for right now, it looks like it's risk on to start, although I think we may see maybe a little bit of a turnaround as we bump up against some of those resistances. So that's what I'm looking at, gang. Good trading to all.